welcome to Market Domination. I'm Julie Hyman, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
December's been rough. I don't think there's anything more to it than just a great year and some profit taking, some tax loss selling in those stocks that deserve, that are down for the year. But yeah, it's been a great year. So I don't think anyone should read too much into an off month.
We need other names to pick up and carry the ball in 2025, and I think we're going to see that happen. The tech sector is obviously going to have the strongest growth, but we need to see everyone else participating. So again, it's that potential. The estimates are there as long as these companies can execute and deliver. I think you'll see the market stage another strong rally in 2025.
He lived a exemplary moral life, and he dedicated himself to helping others. He moved us towards energy conservation. You mentioned he was instrumental in probably the most important Middle East treaty of recent times. And then all of this was reflected in his post-presidency. Of all presidents, Jimmy Carter's leadership cannot be summed up in his 4 years as president.
We got 1 hour to go until the market close. So let's take a look at the major averages here. Third straight day lower for the major averages here, particularly for the S&P 500. But if you're looking at the Dow here today, we've got a pullback of 277 points, about 0.6%. The S&P 500 down about 2/3% here. So the 3-day losses for the S&P now around 1.8% or so. And the Nasdaq Composite also down over the 3 days, and over today also down about 2/3%. Couple of things to note here. First of all, the breadth continues to be negative here. In other words, the S&P equal weight index is underperforming, more decliners than advancers we are watching as well. So pretty broad-based declines here as we are watching stocks go down. We did get a couple of relatively minor pieces of economic data that still bear mentioning today. One of them, Chicago Purchasing Managers Index, showing an unexpected decline, and then pending home sales on the flip side rising for the 4th straight month in November to their highest since early 2023. What does all of this equal in terms of the bond market, which has definitely been something that's been affecting what's been going on in the stock market? We've got the 10-year yield holding here at about 4.55%, but yields here moving lower, money moving out of stocks, moving into bonds. So prices higher, yields a little bit lower today as we see that 7 basis point pullback. And over this 3-day period, we have seen yields kind of steady and then moving a little bit lower here today. We're also looking at the groups in the S&P 500 here today. Here are your sectors. Energy very slightly in the green, materials, healthcare, consumer discretionary. It's the end of the year here, so they've got some end of year positioning potentially happening. We're going to talk more about that. But I also want to flip it and look at the year to date, because sometimes in the waning days of a year, or even the first few days of the new year, you get some rotation, out of the big winners of the year into some of the losers of the year. Is that what's happening today? It doesn't really feel like it, right? You're not necessarily seeing that sort of one-to-one or reverse correlation that you tend to see. And then also something else I want to check on that we're going to delve into a little bit later in the show as well is Bitcoin. We are seeing Bitcoin bounce a little bit today. It's still well below that northwards of 100,000 where it was a couple of weeks ago, but a little bit higher in today's session. We're going to talk about the outlook for 2025 for the cryptocurrency and cryptocurrency more broadly later in the show. Well, stocks did take a dramatic downward turn over the past few trading sessions, putting to rest traders' hopes of that Santa Claus rally through the year end. Joining us now, Steve Sosnick, Interactive Brokers Chief Strategist. I guess technically the Santa Claus rally also encompasses the first 2 trading days of the new year, so there's always hope, I suppose, for something big coming. But what's going on here? Because it is pretty unusual to see the kind of year-end selling that we've been seeing.
Well, hi, Julie. Great to join you. I think what we're seeing here is some asset allocation going on into year end. Typically for individual investors, what you see is the tax incentive of selling losers and holding on to your gainers till next year, because you'd rather take the loss in the short term, in the near term, and then hold on run your gainers into the following year, or hope they become long-term capital gains, which are taxed more advantageously. But I think what's happening here is, I think some investors like pension funds who don't have tax considerations to worry about are reallocating into the end of the year. Because if you think about what we saw, we had the S&P and basically everything rising into the end of the year. And over the last 3 weeks, we really saw yields pick up dramatically until today. When yields pick up, bond prices go down. So if your mandate is to be 60-40 or 70-30, whatever your equity bond allocation is, the stock portion went up and the bond portion went down. Well, how do you rectify that? You sell stocks, you buy bonds. And interestingly, we saw the selling begin really begin in earnest on Friday. Thursday was kind of just a little bit of a normal tick lower. But Friday we had some real selling. And it was interesting, the bonds didn't react, but they reacted today. But when you have a T+1 settlement cycle, this is when you'd have the money to put into bonds. So I do think that was the follow-through what we're seeing is the follow-through this morning.
I mean, you had this 3-day bout of selling, but you had a 3-day bout of selling also sort of in mid-December. So it's not, but I have to wonder if you're hearing any chatter at all. Yes, of course, you've got the technical stuff at the end of the year. Is there any kind of sentiment shift at all? Or is there any kind of nervousness under the surface? I mean, we've not been hearing it on the surface. Most strategists are pretty optimistic about next year.
Well, clearly the optimism is still out there. I think the Fed meeting caught a lot of people by surprise. I mean, we had sort of that 3% round trip on Powell Day, and then it continued into the end of the week. Then early last week, you had two big rallies on very light days, Monday and then a half day Tuesday. You had big rallies. We since at the worst today gave that back. I think I haven't looked right now where we are exactly. It's about a push. So if you look at the Santa Claus rally, as you were referring to, as the last 5 days of 1 year and the first 2 days of next year, we're pretty much finishing up day 4 out of 7. So I'm not kicking Santa Claus out of the room right now, but I think the people are a little bit shaken. I think they were quite a bit surprised by the reaction to Powell, because I think what he said there wasn't necessarily so out of line with what the markets were expecting. We went into it expecting 2 cuts for 2025 and hawkish rhetoric, and that's what we got. Yeah. And then we had sort of the bounce into, the bounce on nothing volume, and then the sort of out of the blue sell-off on Friday. I think that's got some people contemplating whether there's a little more to the selling than just sort of end of the year shenanigans.
Do you think there's too much optimism going into next year? I mean, it's not like people, by and large, are not looking for another double-digit rally necessarily, or certainly not a 20% rally, but they're looking for a rally.
Well, I pretty much almost everybody. I can't put numbers on it. My firm won't let me do outright recommendations. But when I look at it and see that pretty much every one of my counterparts, I can only think of 1 or 2 at most, who are not looking for somewhere between 7 and 10 or 12% higher. And so if everybody's on one side of the boat, the contrarian in me says, you know what, maybe you got to get back to the other side of the boat a little bit. Be fearful when others are greedy, is the old
What
Buffett.
are they missing potentially?
I think what they're missing is the fact that so much good news is priced in. So let me stipulate that I don't disagree. I don't have an independent way of saying, okay, 15% growth for the S&P 500 earnings is not going to happen, because we don't know that. Now, you have 2% in GDP growth and 2% inflation. It's kind of a high hurdle. It means you still have to come up with about 11% extra above that, in terms
to get to that
15%. But let's say it happens, but then it's priced in already. So you've got all this good news priced in, and we have a lot of unknowns regarding the fiscal policy next year. I mean, starting on January 20th, we don't really know what executive orders are going to come down. By the way, January 20th is a market holiday, so it'll be actually 4 out of 5 weeks in a row with a day off. Yeah. But what happens is, so there's a lot of stuff in there that I think the good news is priced in, and I don't think there's a lot of skepticism priced in, and I think we're really going to need to know in January whether companies can reaffirm that guidance that's priced into the market. If they can, then we can continue higher. If not, that could be very tricky.
Just a quick technical question about those short weeks that you just mentioned, right? So this week, obviously January 1st is going to be off. Next week, we've learned that there will be a National Day of Mourning to honor President Jimmy Carter. That'll happen on the 9th, so another shortened week. We've got Martin Luther King Jr. Day coming up. That'll be a shortened week. Mm-hmm. Anything that traders, people who are in the markets need to be aware of when you've got all these shortened trading weeks?
Not necessarily. It means you can get some weird moves, like the Friday after, Friday the 10th could be a weird one. The Mondays, not so much. Markets used to dealing with those. The fact that we had Christmas and New Year's on Wednesdays means you have very, very disjointed weeks. So I think that's kind of why we're seeing a little excess volatility, both up and down, over the past few sessions. And I think, for example, the Martin Luther King week, everybody knows that's coming. It's Monday. Markets used to dealing with that. The only people who really have to deal with these twists and turns are people who are trading very short-term options. Because if you had an option that expired on January 9th, because now we have daily expirations, well, you just found out that's really expiring on January 8th. Or if you had an option expiring January 10th, well, you just lost a day of volatility in there. So those are very technical calculations, which if you're trading very short-term options, you should understand those. But for general investors, it just means you could get a little bit of little extra potential for weirdness on those kind of
Prepare for
those
weirdness.
island days. Yeah.
Gotcha. All right, Steve, stick around. We're going to chat with you a little bit more about some other movers in just a moment. But first, now we have to turn to the latest on Boeing, the jet maker facing renewed pressure after South Korea ordered an inspection of all of its 737-800 models following that deadly crash that killed 179 people. Here with more, Yahoo Finance's Pras Subramanian. And Pras, when we look at the plane's role in this, what's sort of being looked at as what could have gone wrong and what maybe had to do with the plane itself?
I think there's two parts to this. What happened yesterday was the pilot reported a bird strike apparently, and there's video of the plane hitting potentially a bird and having the engine flame out. That was one issue, but then it landed on its belly with no landing gear deployed. That's another issue. Why did that not deploy properly? And apparently there's an earlier Jeju Air flight that didn't have a landing gear issue too, and that had to return back to its airport. So there's a lot of questions here as to why the landing gear did not deploy. Is that a Boeing issue? Is that a safety? Is that a service issue with Jeju Air? That's the question that needs to be answered. The black boxes are recovered. They got to look at those things. But if you're Boeing, it's not a good look for you after, again, another potential safety issue. You had the door plug blowout in January. You have this latest issue with the 737-800, which isn't a MAX jet. It's an older jet, but it's a workhorse jet. Something like 4,000 of these jets exist in the world today. So it's just kind of a scary issue here for trying to figure out what happened as to why this plane. Also, the airport had this concrete wall at the end of the runway. Questions about why that exists. So a lot of questions here as to what happened and why such a horrible outcome occurred.
Now, going back to the 737-800 for a moment, as you said, there are thousands of these planes in service around the globe. And it's not one that has had habitual issues that we know of, right?
Right. No landing gear issues that we know of. No issues that the MAX plane had with the MCAS system. It's a pretty safe jet, apparently. It's just that it seemed at this point there was a confluence, a lot of bad things. Like I said, the bird strike, bird warnings in the area, and then the landing gear not deploying properly, which is a major concern, is sort of the main problem here. I guess we'll find out more with the black boxes.
Yes, we'll count on you to keep us updated. Thanks a lot, Pras. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, we'll discuss what's driving some of the top trending tickers on Yahoo Finance. Plus, U.S. consumers are expected to maintain robust spending in 2025. We'll look at which retailers could be best positioned in the year ahead. All that and more on Market Domination. Stick around. We'll be right back. now it's time for some of today's trending tickers. You can scan the QR code below to check out the best and worst and most viewed stocks of the session on Yahoo Finance's trending tickers page. Now I'm rejoined by Interactive broker Steve Sosnick, as well as Yahoo Finance's Josh Schaefer, to chat about some of these movers that we're watching today. And one of the movers, of course, that's not just a mover of the day, it's a mover of the year, is Nvidia. The latest news with Nvidia today, it's completing its acquisition of an Israeli AI firm called Run AI. Watching this here, the company apparently it has software that helps owners of intelligence computing gear get the best out of their hardware. That was how the Bloomberg report.
It helps you use your chips better and smarter, right? It's sort of how I was reading it, which to me fits into a little bit of part of the Nvidia narrative that we've been talking about over the last week or two, right? It was, I think maybe a week ago now, I was on with Madison Mills and we were talking about Nvidia's playing cloud, right? And trying to build out cloud. And this is also, okay, I bought an Nvidia product. What do I do with it? How do I use it more efficiently? And it's a smart play for Nvidia when you think about just the growth of the company, right? You sell all these people these products, how are you going to keep making money off them and sort of continue to grow top line if it's not selling chips? Maybe it's the services aspect, right?
Well, it's been, I mean, the integration of software and hardware has been one of Nvidia's innovations as a chip maker, right? The other chip makers haven't necessarily done that with the same degree of success. What's interesting here is that it sounds like Run AI is also potentially going to provide services for other hardware systems, not just Nvidia's. So just another, I mean, I know you watch Nvidia closely, very closely, Steve.
You can't not.
Right, and so how are you thinking about it as we go into 2025? And there's this relentless push from Nvidia and its cohort to come up with what's next.
Well, that's really the key. I mean, you know, if you think of AI as the gold rush, and, you know, these are the ultimate pick and shovel. NVIDIA is the manufacturers of pick and shovels for the AI gold rush. And, you know, to the extent that this makes their products more saleable, more useful, provides a longer revenue stream, it makes a lot of sense for all the points that Josh raised. But, you know, to me, NVIDIA is going to remain, at least for early 2025, the stock to watch. And I think, you know, as I brought up in the earlier segment, Earnings expectations are very high for the S&P 500. Well, the S&P 500 is a top-heavy index, and NVIDIA is among the things making it top-heavy. And the one interesting thing is shortly after the inauguration, we launch into earnings season. That's when we start to hear the guidance from basically most companies, and all the big cap tech companies, with one big exception, NVIDIA, which is a month later.
Yeah.
And so to me, it's going to be very crucial that NVIDIA can maintain the type of earnings growth that's priced into it. There's a lot of good news priced into this stock. Doesn't mean I'm not going to say they can't do it, but they have to keep this going at a very, very rapid pace to maintain the stock price and maintain the momentum that they have.
And the momentum has faded a little bit here at the end of the year, right? It's still the second best performer in the S&P 500 this year, but it's 6% below its record where it closed on November 7th, right after the election. And it's had some sort of it's had something like 3 corrections this year. So we've definitely had
It's in the intermediate post-earnings when NVIDIA kind of doesn't really go anywhere for a little bit, right? And it feels like there's all these news headlines, and then as it gets closer to earnings, it seems to rally. That's kind of been the trend, at least for the past couple quarters. It'll be interesting to see if we get that early in 25, too.
Yes, it will be. All right, let's also talk about some energy sector movers today. Natural gas in particular, those prices are surging. That's because we're getting new forecasts that actually January is going to be much colder than previously expected. So that moved today. At one point, it was closer to 20%, and that was a record in the current contracts going back, I think, to 2012 or so. So it's a pretty extraordinary move that we are seeing, even though I find natural gas trading fascinating, you guys, because, it's going to be cold in winter. And
surprise.
I mean, I guess there were forecasts for a more mild winter. Now we're learning it's not actually going to be mild. But even so, it's just an interesting market to watch.
I think right now the story with UNG was really the technicals and natural gas and UNG, being the ETF that tracks it. If just pulling up a chart on it, because I really hadn't been paying close attention to it. It sort of has this, nice little rounding bottom for the past couple months, and we sort of broke above the levels, the resistance levels. Without Jared here, I don't have all the technicals in front of me. But bottom line is, it's a nice technical move. Longer term, it's got a lot of work to do, and you could think about one of two ways: glass half full. Well, if you go back even to where the levels that prevailed through most of 2023, that's a big rally you can have from here. We're not even close to where it was late 2022, but that was Ukraine nervousness and everything else. So there is a lot of room for it to run if you perceive this. But again, some of it, commodities trade off of technicals. And again, this is a thin period, so I don't want to read too much into it, but I would say that I was quite impressed when I pulled up a chart of UNG today.
And even just looking at some of the energy stocks that we saw pop in today, I was looking at our Wi-Fi Interactive and just taking a look at some of the stocks that had underperformed significantly this year, and then when you flip the screen to today, those are the same stocks that are leading, right? You look at maybe a Devon Energy, look at a Murphy Oil Corporation, also saw Cosmos Energy getting a pop today, and so we're looking at right here, this is your year-to-date, all these stocks that are down on the bottom here. Then we go over to the intraday. Oh, look, our same tickers are showing up right there, right? And so you're kind of seeing perhaps just a little bit of, I hadn't looked at nat gas in a while. What's not doing well there? And, those stocks have really been hammered this year, so not necessarily shocking, as Steve said, also in a low volume trading day for those to catch a little bit of a bit.
It's also been interesting to me that natural gas has not done better given the discussion we've been having around data centers, around the increasing need for power. And nat gas, yes, a lot of these, the companies are migrating towards more renewable sources, but nat gas is viewed as a sort of less dirty, petroleum product. But it has not benefited to the same degree that, say, Vistra, which is the best performing stock in the S&P 500 and is a power company, to the extent that that's benefited.
It's my favorite trivia question in the end of 2024. I wonder how many people would say Nvidia over Vistra as the top performer in the S&P 500.
It's a fun one.
Yeah. It is.
I'm going to do that at New Year's Eve parties.
We have tomorrow, the final trading day of the year, Julie. We can run trivia that.
Good. Oh, we should do trivia tomorrow. That's an excellent idea, Josh Schaefer. Okay, stop me if you've heard this one before. MicroStrategy is buying some Bitcoin, more Bitcoin, in fact, $209 million worth of Bitcoin to be exact, according to the company. That said, MicroStrategy's Bitcoin buys have been slowing down gradually. It did a couple of big buys when it first began this round, and then it has been sort of slowing down. As you can see there, the purchases were much larger in November, and then they have gotten slower here. But it is still the 8th straight week that it has been doing this. And as we know, the company has no plans to stop this particular strategy of leveraging its balance sheet in order to buy Bitcoin. What's changed is that the stock has started to underperform Bitcoin. For a while there, it was trading at a significant premium, and it still is at a premium if you value its balance sheet versus Bitcoin. However, it's come down pretty sharply from its highs.
Yeah, it's been interesting to see MicroStrategy start to fall off a little bit here. And I think what's interesting to me is the concept that our friend Jared Bilkery has brought up multiple times, which is MicroStrategy usually leads Bitcoin on the way up. I have not checked in with him on if it normally leads Bitcoin on the way down as well. But MicroStrategy had started rallying kind of long before the Bitcoin pop, right? MicroStrategy was rallying before the election. Bitcoin had seen a little bit of a move, but really it seemed like part of the Bitcoin rally maybe was already in the MicroStrategy stock. But MicroStrategy is a weird stock that moves on a lot of different things and a lot of options and stuff I know Steve likes, so I'll perhaps yield the floor to him.
I mean, and Bloomberg has been reporting also that certain hedge funds are sort of using MicroStrategy in much more complex algorithmic ways than I can explain.
Well, the way that I would think about MicroStrategy here is it's a leveraged closed-end fund that holds Bitcoin disguised as a software company. So they still have the software company wrapper, but essentially their business model is let's issue convertible bonds or let's issue stock to buy Bitcoin.
Yes.
Well, if you're using bonds to buy something, that's buying it on leverage. So it's a leveraged play on Bitcoin, which is why it does tend to lead. And quite frankly, among our customers, we see MicroStrategy lead, we see people trade Coinbase, Marathon. So those are all sort of levered to the price of Bitcoin. Marathon being a miner, gold miners are levered to the price of gold. It's just natural. So what you see here, though, with MicroStrategy is they can't stop this strategy. Now, first of all, if somebody's going to pay, if somebody's going to pay me 2 times my net asset value, and it's probably more like 65, 70% right now, well, why wouldn't I just keep issuing stock? At 2x and buy the underlying at 1x. It's a money machine until it stops. And obviously that requires, people willing to keep taking on the stock. You can't do that indefinitely because ultimately, maybe they can try to corner the Bitcoin market, and I'm thinking right now of my favorite movie, Trading Places, where, but with the orange juice, but it's not exactly the same. But what you're seeing here is, so that's where the strategies come in. So the convertible, if you issue convertible bonds, eventually you do have to get the income and pay that back. So this all, at some point, there feels like there's a natural end to this cycle. I don't know when it is though, and what it is. But if I'm Michael Saylor, I'm in for a penny, I'm in for a pound. I'm just gonna keep doing this because why not?
And he has said very explicitly he's not selling any of it, like ever.
Well, at some point you have to. At some point you got to pay back the convertible bondholders. So.
Right. The question is how. Right. Does somehow the underlying business software company start to throw up more cash, or do you figure out a way to monetize the Bitcoin? That to me is the big question with regards to MicroStrategy, right? Because he's not selling it.
Yep.
What do you do with it?
I mean, perhaps he holds enough of it so that he can lend it out at a higher rate than he has on the convertible bonds, which is all part of the strategy of cornering the market. I don't know, and he's a little bit inscrutable, so I'm not going to. I don't want to just speculate motives on television. That's not good for any of us. But I do think that. It's certainly this is the kind of thing that Harvard Business School class of 2040 is going to be writing case studies about. Mm-hmm.
Definitely.
For one way or the other.
All right, Steve, you're going to stay here. Josh, thank you so much. Appreciate it. And we're going to keep talking about crypto right now because, of course, it hit a lot of milestones in 2024. Bitcoin surpassed 100,000 on the back of President-elect Trump's election victory. But Bitcoin is having a little bit of a fizzle to end the year. So what could be next for crypto as we move into the new year? Joining us now, Joe McCann, founder, CEO, and CIO at Asymmetric. And sticking with us, Steve Sosnick, chief strategist at Interactive Brokers. Joe, thanks for being here. You probably just heard the tail end of our conversation about MicroStrategy and its strategy this year, which is also something that's sort of been a hallmark, I guess, and has gotten a lot of attention here in 2024. So we saw the huge run-up in Bitcoin in anticipation of, and then in reaction to, Donald Trump's victory. When he actually takes office, are we going to see any kind of a sell the news, or what? How much do you think Bitcoin will be reactive to policy changes?
Yeah, I mean, it's a great question, Julie. So I think first, for 2024, there were three major catalysts. First being the ETF, second being the Fed's easing policy, and then third, of course, the election. So the obvious question is, well, when Trump actually comes into office, what happens to the price of Bitcoin? Are things already priced in? And what we're seeing in the options markets, there's a significant amount of open interest for the end of January strike, as well as pretty elevated vol structures for end of January. What that suggests is that people are anticipating a run up in price again. And we saw this happen with the ETFs in January of this year. Subsequently, there was a pullback. That should be expected. I think the key thing to understand with crypto or Bitcoin in general is it's a very volatile asset class. Now, the volatility is starting to subside because it's becoming more mature. So as we move into 2025, we expect continued institutional adoption, as well as some of the potential wildcards like a strategic Bitcoin reserve. That could actually have a meaningful impact on the price of Bitcoin.
Hi, this is Steve Sosnick here. So my question then becomes, do we see a real use case for Bitcoin in 2025, other than potentially an investment tool or strategic reserve or something of that matter? The blockchain has been promised to us for years, and Bitcoin, of course, is sort of the initial, flowering of the blockchain. Do you see a use case other than as an investment vehicle or as an asset?
Yeah, I mean, look, it's a fair question, Steve, right? Look, Bitcoin is the kind of genesis of blockchain-based technology, and it has pretty much supplanted itself as digital gold. I think that is a very valuable concept for investors because gold has been around for hundreds of years as, an inflation hedge or a hedge against financial stress. At Asymmetric, we actually are a venture capital fund as well, and we invest in specifically out of a fund in early stage companies that are building on Bitcoin. So there's actually a proliferation of companies that are utilizing Bitcoin at the settlement layer to build interesting, call them decentralized financial products that currently exist in places like Ethereum and Solana. Now, the big difference is other chains are well ahead of Bitcoin. However, Bitcoin has the largest, market cap, and the value associated with Bitcoin is yet to kind of feed into some of these new DeFi applications. But there's been a tremendous amount of developer activity that's happened in the Bitcoin space. So I think you'll see actually a number of use cases. You mentioned potentially Michael Saylor lending his Bitcoin. Well, there are protocols now that already exist for Bitcoin lending. This is just an example of the type of innovation that is going to continue to come with real use cases on Bitcoin in 2025.
Joe, we've talked to a lot of folks about policy changes that could come, and a lot of that policy change has to do with getting out of the way, it seems like, on the part of regulators. What changes are you expecting for those businesses that you're investing in? Because it seems like you've been already doing it, right? The companies you're investing in are doing that work. How much easier will it be? Will it not be meaningfully different? Or, what are you expecting?
I mean, it is by far the most bullish catalyst for the entire industry. I mean, the way that I've kind of described it to the founders in our portfolio companies today is forget everything you've known about the challenges with crypto's regulation or lack thereof. It is an entirely new world. That is a huge set of expectations that we do have for the Trump administration. But if you look at the appointments that he's put in place, these are real builders, folks like David Sachs, and even getting advice from folks like Mark Andreessen, bringing, I would say, just common sense to enabling founders, innovators, and entrepreneurs to build in the United States. And so from a pure regulatory standpoint, I think there's some basic blocking and tackling that will occur. One being the stablecoin bill will likely get pushed through. Will we see the market structure bill come to a vote and pass? That's kind of TBD. But ultimately, what we're looking for is clarity. And I think some of the folks that he has put into positions at the SEC, some of the financial services committees, et cetera, are not looking to just allow sort of a cowboy-like environment as it relates to crypto, but bringing common sense regulation so that crypto can actually thrive in the United States.
To that point, Joe, then where's the sort of the happy medium of regulation? Because obviously crypto grew up in an environment, when it was the Wild West, and it had its first flourish then. Now, obviously, there's a lot of people, as it becomes more institutionalized, more held by retail, ETFs, et cetera, there is sort of a need for regulation. Broadly speaking, where do you see that intelligent regulation ending up?
Yeah, I mean, from my perspective, it is as simple as, are crypto assets securities or not? I would argue, and I think the entire industry would argue, that they are not. The CFTC has currently argued that they are not. We have had a lack of clarity from the SEC on this, where they're naming certain assets as securities, but not actually confirming that they are securities. So that aspect alone has a huge downstream impact on other areas of regulation. So if, for example, we find out that, say, the CFTC is going to regulate crypto as commodities, that fundamentally changes the landscape for crypto assets, and not only how they can actually be issued, but most importantly, how they can start to look like stocks. Currently, most crypto assets don't pay, quote, dividends, which in crypto we call protocol revenue, because of fear by the founders that it could look like a security. If we get some sort of regulation around that, you may start to see crypto assets look much more like stocks that pay dividends versus what they are today.
Interesting. Thank you so much, Joe. Good stuff. Happy New Year, and we'll talk to you soon.
Happy New Year to you. Thanks.
And Steve, thanks so much for hanging out with us today. Appreciate it.
Thank you.
Coming up, we'll discuss the U.S. economy's path forward for 2025 in the face of policy uncertainty. That's next when we come back. With 2025 and then the inauguration around the corner, investors waiting to see how policy takes shape in the second Trump administration. My next guest says, despite the uncertainty, Trumponomics should be better for the U.S. versus the rest of the world. Joining me now, Aditya Bave, Bank of America senior U.S. economist. Thanks for being here. Good to see you.
Good to see you too.
So we're looking at, of course, you're a global economist too. So you look at the U.S. relative to the rest of the world. So I guess we should talk, first of all, about where we are right now, right? And it seems like that the U.S. has come out of the post-pandemic period already in a stronger position. Is that fair to say?
Yes, very much so. So I think we're going into the new year with very solid economic momentum. You can look in the very short term at the TSA's travel data. I was just looking at that this morning around the holidays. It looks great. Our internal data on spending by our credit and debit card customers is showing a really nice acceleration around the holidays. So all of that is quite positive. And then if you look through a wider lens, we've grown at 3% over the last 2 years, nearly 3%. This was way above what anyone was expecting. The Fed still thinks potential growth is 1.8, right? And that's happened with inflation coming down and labor productivity actually accelerating. And that last point is really important when we think about the US versus the rest of the world, because the US already had faster productivity growth before the pandemic, and now it's accelerating, whereas in the rest of G7, it's actually fallen. So that gap has widened quite a bit.
And how are you thinking about now going into 2025, where the U.S. economy is versus where the expectations are, right? I was looking at the Citi Economic Surprise Index as an example, which shows the ratio of reports beating to missing consensus estimates. And it's started to dip negative again, meaning we're starting to see more reports missing than beating.
Right.
So what does that tell us about where we are in the expectations game, so to speak?
So it's possible that our expectations have just gotten inflated a
Right.
bit, right? So we're still pretty confident. We think we can grow at 2.3% this year, which would be trendish from our perspective. So our view of trend is also more bullish than where the Fed is at. And we think we can grow around 2% in 2026 as well.
So 2.3% for 2025 and then
Yes,
2%
yes,
for 2026. Now, we've had a lot of discussions with economists, with strategists. Oh, we don't know what's going to happen with this Trump 2.0.
Yep.
What do you have a higher degree of certainty on when it comes to potential policy outcomes?
So I think markets moved very quickly immediately after the elections to price in deregulation, right? So that seems to be something that can be done by executive action, and we'll probably see a decent amount of it. You'll see it in financial services, you'll see it in energy. Where there's greater uncertainty is probably around, honestly, what we think are the two biggest questions for markets, which would be trade policy and fiscal policy. On fiscal policy, the issue, of course, is that Republicans have a much slimmer majority in the House than we thought on November 5th, right? So it's 220 to 215, which means they can only lose 2 seats. Sorry, they can only lose 2 votes. And on trade policy, there's a question of how much of the tariffs that have been proposed will actually be implemented versus how much is more about, making a deal.
I'm sure you guys run all kinds of different scenarios.
Yep.
If nothing happened from today,
Yep.
In terms of policy, if nothing changed, what would be the trajectory of growth in the U.S. economy? I mean, in other words, that 2.3% for next year, is that sort of agnostic to policy, or do you try and take that into account?
It does take policy into account. We think the policy mix will be roughly a wash for growth, but we do think it'll be somewhat inflationary. So if nothing happened, we would probably still grow between 2 and 2.5% this year and next year. The inflation picture would probably be a little bit more benign. So the combination of potential fiscal easing and tariffs, if they are implemented similar to what's been proposed, that might be quite somewhat inflationary.
And then as we look at the U.S. relative to economic growth around the world,
Yep.
What does that look like given the policy picture?
So the rest of the world is in a more difficult position, right? Especially if you focus on the rest of DM, which is kind of more of an apples to apples comparison.
Markets, yeah.
Yes, exactly, developed markets. So I would say, Europe is in a pretty sluggish growth phase, similar for the UK. Japan is up and down a bit. The US really has been kind of the star of the show, and that's a point that Jay Powell has made many times, right, in his press conferences.
And speaking of Powell, how many times do you think do you believe the 2 cuts that are priced in, or is there so much uncertainty that we can't take anything for granted on the monetary policy front?
I don't think we can take anything for granted, but our base case is 2, although at that point we think they're done, right? So we have a terminal rate of 3.75 to 4%, which would be consistent with just 2 more cuts. The risks, especially given the message that the Fed delivered in December, which we thought was unabashedly hawkish. That's as hawkish as you can be when you're cutting rates. So given that message, we think the risk is very much that they could be done cutting, or there could be only 1 more cut rather than 2 in the pipeline.
Interesting. All right, Titya, thank you so much. Happy New Year.
Thank you. Happy New
Thanks
Year.
for coming in. Appreciate it. Well, U.S. consumers are expected to maintain robust spending in 2025, and here to break down what is driving that, plus some key trends that are set to stick around, Yahoo Finance's Brooke DePalma is with us. Hey, so what's set for the consumer?
Good afternoon. Well, the consumer is expected to continue to spend pretty robustly in 2025. A few experts told me that as long as Americans are holding on to their jobs and allowing, that will allow them to continue to spend here. And some key trends that we're really looking out for is that stronger consumer sentiment. We want to see that continue into 2025. We also want to continue to see moderating gas prices, as well as easing inflation and a better interest rate environment that will allow that consumer demand and consumer resilience here when it comes to their spending to really continue into 2025. That's according to Goldman Sachs analyst Brooke Roach. In addition to that, we also want to see that weekly jobless claims number continue to stay lower. Once Americans lose their jobs, we know that consumer sentiment then changes quickly. But as long as they hold on to jobs, well, then this expert said that will give us a pretty good reason and a pretty good feeling about overall consumer spending continuing to stick around in 2025. But retailers have to continue to win over consumers. They need to have newness. They need to have innovation. They need to have sharp value, and that will really engage consumers to continue to want to spend and really feel the need to spend.
You know, and 2024 has really been a year where it hasn't been like everybody's done well in the retail environment.
There's been winners and there's certainly been losers.
Exactly. So what are you being told about who could be some of the winners going forward to next year?
Yeah, one thing that we expect to continue into 2025 is this idea of off-price retailers. So think about TJ Maxx, think about Burlington, think about Ross stores. We've seen these stores continue to outperform full-price retailers because consumers are sharply focused on that idea of value. Now, in addition to that, companies that are offering that newness, that innovation, making consumers feel like they have to go out and get shopping is Amer Sports and Tapestry. So think companies or brands like Coach, as well as Kate Spade, introducing perhaps these dupes or these ideas of making consumers feel like they have to have it. And also fast casual, think Chipotle, think Cava, think Sweetgreen. Those have done well, introducing this idea of sharp value yet again, really getting the best bang for your buck. Consumers feel like they have to go over there as opposed to maybe others.
And any other trends that you are hearing about and watching?
Yeah, well, certainly we're taking a closer look at the potential impact of potential tariffs in 2025. One company that experts are looking at there is Carvana, the used car market, expected to benefit should there be those tariffs going into effect. In addition to that, value. Can't say enough. That's gonna keep around in 2025. So McDonald's, they're coming out with their McValue menu in early January. That's January 7th. So we're taking a closer look at McDonald's and of course other players within that field. And lastly, discretionary spending. So think Target, think Bath and Body Works, think Dick's Sporting Goods. Should that return, then those 3 companies are expected to benefit. Of course, we have seen discretionary spending fall off a bit, but many, including Goldman Sachs, expects that to return as early as Q1 2025.
Ooh, a lot to watch in there, Brooke.
Just a few things.
I'm ready. You're going to be busy. Okay, thanks a lot. Appreciate it. Well, checking in now on shares of Hain Celestial. It's under pressure after a court ruled Friday that the organic food company would have to face a class action suit that alleges it mislabeled baby food products that contained unsafe levels of arsenic. At least that's what the suit says. The suit argues the company failed to inform parents and caregivers of the level of arsenic and other heavy metals in some of its products. Hain, which includes brands like Earth's Best and Ella's Kitchen, had requested the claims be dismissed. Now, while the court did dismiss the class action's claims involving several heavy metals, the class action suit related to arsenic levels has been permitted to proceed to discovery, and we see the shares down by about 7%. Coming up, the film industry breathing a sigh of relief as it enters 2025. We'll take a closer look at which names are best positioned on the other side of the break. Billionaire investor Bill Ackman driving shares of Fannie Mae and Freddie Mac higher. In a lengthy post on X, Ackman suggested the two government-sponsored enterprises could exit conservatorship in the next couple of years and be privately held again. Ackman's been invested in Fannie and Freddie for 10 years, but hasn't been a good investment for him in that time. In the post, he writes, quote, a successful emergence of Fannie and Freddie from conservatorship should generate more than $300 billion of additional profits to the federal government. He says this is on top of the $301 billion of cash distributions already paid to the Treasury, while removing $8 trillion of liabilities from our government's balance sheet. Ackman going on to say he sees the companies going public around 2026. Fannie and Freddie have been under government conservatorship. Basically, they've not been privatized since the housing crisis in 2008. And by the way, they spiked after the election because there was this expectation that they could potentially be not under conservatorship under a Trump administration. So Ackman sort of reviving that speculation. While 2024 box office revenue was below 2023 totals and 2019 pre-pandemic figures, the film industry is still breathing a sigh of relief as it enters 2025. Joining me now, Alicia Reese, Wedbush Securities Vice President of Equity Research. Alicia, it's good to see you. And I guess breathing a sigh of relief in part because 2025 is expected to be better, but also the end of 2024 sort of improved over time. What was driving some of those improvements?
Well, we saw a really nice improvement in the third quarter, despite pretty negative effects from the SAG-AFTRA strikes late last year, and also from a difficult comparison from Barbie and Oppenheimer in the third quarter last year. We still saw some really nice growth in the third quarter, and then there was an easing comparison in the fourth quarter. Some really nice, comparisons year over year, but you had some tough. Some tough hits early in the quarter, followed by some really nice family-friendly fare the rest of the fourth quarter that has just played very well.
Alicia, I'm curious also, I was going through, I was getting excited for 2025 movies, going through your predictions for what might be some of the big box office hits. I'm struck that it's a lot of more of the same, a lot of Marvel movies, some more Marvel movies, some more sequels, some more of the same franchises. But talk to me about why you think that's going to get people into the theater, and what do you think the biggest hits are going to be?
Yeah, I do think that there's a good variety of titles coming out over the coming year. There are some sequels, there are some Marvel titles, but that's not it. I do see a lot of family-friendly fare on the docket, which, as you can see in the fourth quarter, people are starved for it, and people are certainly going out to see that. A lot of titles are going to be on IMAX screens and playing, shot with IMAX cameras. That can drive some extra viewership, some extra movie going. And for the movie theaters, they're just offering quite a bit in terms of concessions and just driving a lot more revenue per attendee. So they're really positioned well if they can get people in with those titles. And I do think you just have some good variety coming over the next year. I think in the second quarter, when you have Mission Impossible, this is the last foray for Tom Cruise in this series. It is a sequel, of course, but it's the last one, and I think they're going to market that really well. Last year they had a bit of a snafu with Oppenheimer coming out. They didn't film on IMAX cameras, and so they didn't get that guaranteed window on the IMAX screens. This year, they're not making that mistake, and they're certain in 2025, they're not making that same mistake. So that should play really well. And then you end the year with Avatar. I think that's going to play really well.
And you mentioned the windows. Do you think that sort of we'll see more of a return of that theatrical exclusivity window that had sort of gone away and then came back a little bit this year? Do you think that we're going to see more of that next year?
Well, I don't think you really need to. I think what we saw pre-pandemic, there was so much concern around those windows and the death of theatrical coming because the windows were going to get shortened by the streamers and studios shrinking those windows. What we saw post-pandemic is that it hasn't made a big impact. The films that are not going to play 90 days anyway are able to go directly to streaming. That really benefits the streamers, and as it reduces that marketing window for them. And it also benefits the theaters because they get a better film rent on those titles. For the films that are playing, really well, let's see Top Gun Maverick as an example, that played well over that old 90-day average. That used to be ironclad. Now it can, the best films are going to play long runs. The ones that don't play well are going to open up screens for the theaters. Everyone's going to survive and everyone's going to be okay in this business. So the concern around that has just kind of dissipated.
And Alicia, you mentioned IMAX. That is your top pick going into next year. Why do you like IMAX so much?
Well, I think it's just best positioned in the theatrical space, and its valuation still has some room to run. There's a lot of footprint growth potential globally for IMAX. You also have the benefit of 14 plus titles that were filmed on IMAX cameras playing in 2015. Now that compares to an average of 1 to 3 per year this year and prior years. What you'll see on most titles that were filmed on IMAX cameras is a pretty big market share gain for IMAX. Oppenheimer, Dune 2 chief among them in recent history. Some flops happened, Joker 2, but IMAX positioned itself really well by playing, as much titles as it could in the fourth quarter, and so they were able to balance it out. But with that volume of releases coming in 2025, they're sure to get several hits out of the year and gain more market share domestically, and then internationally, footprint growth, as I said, and just playing more local language titles throughout its international footprint.
We'll be watching that one. Alicia, thanks so much. Appreciate it.
My pleasure.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street, and now it's market domination overtime. Let's start with where the major averages ended this session. We saw a little bit of a trending downward at the end of the day. Here's the Dow Jones Industrial down 418, but still obviously well above the lows of the day here. If you look at the S&P 500, the same holds true, although its dip is a little more noticeable, off by about 1.1% when all was said and done, making for that 3-day decline of 2.2% now. And then finally, we've got the Nasdaq Composite down 1.2% on the day, down closer to 3% over this 3-day bout of selling that we have seen from the major averages. And the equal weight actually finishing down less than, meaning we're being pulled down by these large cap stocks here. So if we take a look at the Nasdaq 100, that becomes a little bit more obvious here. Here's the Nasdaq 100. Now you can see, first of all, that most of it is red. So the breadth here was broadly negative. That is, decliners outpacing advancers. We're going to talk more about that in a moment. And then when you look at the Magnificent Seven here, Nvidia, the only one that is higher. Tesla continuing to see selling pressure here, down by 3.3% here. And if you look at the 1-month chart for Tesla, you see that up, but then it's sort of come down here since mid-December, that broad selling that we have seen in the tech space, in large cap tech in particular. Microsoft, Apple, Amazon, and Meta all down by at least 1% on the day, again, as we see this continued rotation out of tech. Now, we talked to Steve Sosnick earlier, and he said potentially that's as we get some end-of-year rebalancing as people realize they were overweight stocks or overweight, in particular, large cap tech because of the gains that we've seen this year. Of course, just to put a fine point on that here, if you look at the year to date for the Nasdaq 100, it is a very, very different picture. So you could see some year-end repositioning as one of the reasons behind this recent pullback that we have seen. But speaking of pullback, let's pull back the curtain a little bit. Let's talk a little bit more about what we're seeing today. Bad breath and the Santa Claus rally. Those are just a few of Josh Schaefer's favorite things. Our markets reporter is joining us now with more of the trading day takeaway. So talk to me a little bit more about this breath issue that I was just mentioning a bit.
Yeah, Julie, so you brought up the Advancers Decliners Index and taking a look at where we closed on that. Looks like we had 440 stocks in the S&P 500 declining, so the majority of stocks in the index declining. This is something we've been talking about really for a lot of December at this point. In the beginning of December, it was okay because those large cap tech stocks you were just highlighting were in the green and they were sort of holding up the rally. We actually hit a couple S&P 500 record highs to start December. What's happened now in the last 2 weeks is, well, the mega caps have fallen off, and now we're looking at the rest of the market and realizing no one's really there to help out the market either. And so this is what happens when we talk about this concentration of the market and nearly 40% of the S&P 500 being the top 10 stocks. Well, if those stocks aren't going up and the rest of the index isn't doing much either, then you start to have some issues. And one note I wanted to highlight, Julie, that I thought was interesting, this was from Bespoke Investment Group. They were taking a look at the S&P 500 equal weight, so that index that doesn't move as much based on the size of the stocks, right, versus the market cap weight of the S&P 500, the normal index we talk about, the equal weight there, down about 6%. The S&P 500 in December only down a little bit more than 1%. It's the worst performance for the equal weight versus the market cap weighted since March of 2020. Not a good month for stocks, if we remember.
Yeah, that is really interesting, because we've had this whole discussion about everything's going to broaden out. It's going to broaden out. It hasn't, at least the good performance broadening has not happened. The bad performance broadening has happened.
You've had broad-based red days recently, for sure.
Broad-based movement together. And then there is the Santa Claus rally.
Yes.
The idea that we're looking at the last 5 trading days of the year, the first 2 trading days of the new year. And, it seems to have made people uneasy that it looks like it's going to be negative unless things turn around.
Yeah, so typically the way the Santa Claus rally works, right, is so it starts December 24th, and in the last 7 trading days, that actually bleeds a little bit into the start of January, right? Normally the S&P 500 would rise 1.3%. That would be the best 7-day stretch that the S&P 500 ever has. That's the best 7 days it puts together. This is per LPL Financial. So 1.3 during the Santa Claus rally. The average 7-day split for the index is actually just 0.3%. And the reason people are worried about this, Julie, is because normally if the S&P isn't positive in this period, stocks don't do as well in the next year.
Right.
The quick thing I would point out with that, when is the last time the Santa Claus rally didn't come to fruition? last year.
Oh.
What happened to the S&P 500 over the last year? We were just fine, right?
Yeah.
And so I don't get me wrong, I understand why people reference these historical things, and I get that more often than not, the average is lower. You get about a 5% return versus a 10% return over the next year when the Santa Claus rally doesn't hit, and it's going back to 1950, sure. But you just had a year where this didn't happen, so I don't know how much stock I really want to put in that when we just watched everyone say, oh no, the Santa Claus rally didn't hit, the market's too concentrated, yada, 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 and it just didn't really work in 2024.
I mean, listen, we have conversations all the time about like these fun historical tidbits.
That's what they are, they're fun.
They're fun historical tidbits. Sometimes they work, sometimes they don't, but we have fun talking about them. Past prediction, past performance is no, guarantee of future results.
Yeah, and I think the few strategists that have still been sort of producing research over the last week in this holiday little bit of a quiet period, right? What they're pointing out to clients right now is, yes, you're not getting your Santa Claus rally, but has that changed your thesis for 2025? What has come out in the last 2 weeks, and I just mentioned it's been quiet, basically nothing's come out since the Fed meeting. There's been little bits of economic data that quite frankly haven't been that great, but there hasn't been a ton of solid data. It's not like we've had a jobs report. We had one inflation report that was actually better than expected. There hasn't been a ton of thesis changers. If your thesis for stocks to go up in 2025 was strong earnings growth in a resilient US economy that will continue to grow and not contract, that's a little bit thesis intact headed into 2025. So let's wait for something real to happen.
I don't know, maybe people getting their Christmas and Hanukkah presents and they're thinking, is that they're extrapolating, they didn't spend as much on me as they did last year. What does this tell me about the economy?
Because they're worried about where things are headed.
Sure.
Yeah, okay, all right, I like that read. Yeah. Maybe not
That
quite,
is
right?
wild and blatant speculation. Josh Schaefer,
We need it sometimes.
thanks a lot, appreciate it. Well, so much for that Santa Claus rally. Stocks are limping into the new year. My next guest is betting on mama stocks for 2025. This is a new flavor for us on the Magnificent Seven amid the threat of potential stagflation. Joining me now, Rockland Trust SVP and Director of Research, Doug Butler. Doug, thanks for being here. So first of all, I don't know how much of the conversation you heard between I and Josh Schaefer, but this idea that the markets feel a little bit more meh. Sentiment doesn't feel as strong going into the end of the year, but nothing necessarily fundamentally has changed. What's your fundamental setup going into 2025?
I think our fundamental setup is that we don't have a great outlook for the economy going forward. I don't think anybody will have a great indication until we see what comes out of the sort of first 90 days of the new administration. Really trying to think about where we head inflation-wise, where we head with government spending, where we head as an overall economy is really going to be dependent on which policies get implemented when. I think I did see a touch of your previous discussion, and equal weighted has underperformed dramatically this month. It's having a better day today. Equally weighted Nasdaq is getting killed by the Nasdaq as well for the full year. It's down almost 25%. So we do think that broader recovery will spread to more stocks than just these highly concentrated few. And then you do have to have something in that highly concentrated few. So we've sort of dubbed it, we like the mama trade. So it's, it's Microsoft, it's Apple, it's Alphabet.
And Meta.
Meta,
and,
yes. Meta, we're a little, Meta's had a great run and we're a little on the fence with Meta, but you have to come up with a great acronym now.
Sure, of course, you have to. So why not the full Magnificent Seven, though, I guess I would ask? Why are you would you be more concentrated there?
I think there's a couple of areas. One is we think Nvidia is a wonderful company. We think AI has tremendous potential. We think everything right now is priced as if that magnificent potential over the next 10 years is a fully realized experience. So it really is assuming that Nvidia has this, 10-year head start and their earnings are going to continue to grow at the levels that we've seen. I don't foresee that happening. I think the stock has certainly gotten ahead of what has been magnificent earnings. And Tesla, we really think it's somewhat gotten diluted over this quarter, thinking that, with Musk and being as tightly embedded with the administration, that's going to be necessarily great news for the stock. I'm not convinced. It hasn't typically worked out that way.
And then it's not just the mama stocks that you like. You've got a few others that at first glance, I think the words blue chip come to mind. That old school moniker that we don't use so much anymore. But stocks like Accenture and Exxon and Procter & Gamble, why would you be looking to those?
I think because of our uncertainty about the coming year, again, unless tomorrow is a dramatically bad day, and there's that sort of collapse, we'll see the markets being up 20% back-to-back years. We don't think there's a third year in this rally. So we're positioning ourselves to being, if the markets are 0 to 10% next year on the stock side of things, we still want to have attractive blue chip companies that deliver solid earnings almost regardless of what the economic environment is. So Accenture should be able to continue to deliver on that, being a great outsourcer. Procter & Gamble is as steady Eddie as they come. And again, we don't see us going back to $25 oil anymore. So.
And then. Sorry. And then I was going to ask about the stagflation idea because, most growth estimates are for around 2% or better in 2025. Where would the potential be for stagflation to creep in?
I think the potential for stagflation is if you get, think about it, sadly, President Carter just died today, and he sort of presided over that grim period of stagflation where we had inflation that started in the fives when he came on and jumped into the low teens, coupled with a struggling economy. There are ways you can get there. I don't think we'll get there, but there are ways in which if you pressed, incredibly high tariffs at the same time as you conducted much larger scale deportations than people have modeled in, and you couple it with some sort of geopolitical event, you can get this dramatic slowdown and you could get prices increasing for the consumer across the board. Do we think that's a likely scenario? No, but it's a gray swan if it's not a black swan event.
Yeah, gotcha.
So that's sort of where we are with stagflation. Stagflation's scary.
Yeah, so you're prepared with those picks that we talked about. Doug Butler, thank you so much. Appreciate it.
Thanks a lot. Bye-bye.
Coming up, we're taking a closer look at President-elect Trump's immigration policies, more on what it could mean for the labor market and beyond when we come back. Donald Trump's second term hasn't even started yet, but there's already a fight brewing in MAGA world with Elon Musk at the center. Joining me now are Yahoo Finance's Rick Newman. And this fight, Rick, has to do, as you wrote, with immigration here. Specifically, it seems to be about the H1B visa issue, but it sort of seems bigger than that, too. So break it down for people. What is at issue here?
Yeah, most people don't know what the H-1B visa program is, but Elon Musk certainly does. He says that he once had an H-1B visa, and these are basically work permits for well-educated foreigners, typically with college degrees, who come here to work in some kind of professional capacity, typically at technology firms and often as programmers. And the tech industry says they need these visas because they simply can't get enough programmers, engineers, other types of technical people here in the United States. There's some question about whether there are some companies that that will hire foreign workers because they can pay them less than Americans. That there probably is some abuse in the system. But here comes Elon Musk, who turns out to be Trump's biggest and certainly his wealthiest backer, saying we need these types of visas. And I think a lot of Trumpers are like, wait a minute, I thought Trump was the anti-immigration nativist. Trump is the guy who's supposed to solve this problem with rampant migration. And tons is getting lost in the details here. We don't have time to go through all of this in one segment, but people, including Trump, conflate both legal and illegal immigration under this one word of immigration. But these are two totally different things. What Elon Musk is referring to is a legal program that has been on the books. Companies get these workers legally. But what Trump mostly railed about, at least what many people thought he was railing about, was migrants who are in the country illegally and who are undocumented. Those are the people Trump says he wants to deport. But, during some of his campaign speeches, Trump said, well, there's a program that allows some Haitians into the country legally, and he wants to end that program and deport those people. So what's going on here is there are actually many types of immigration. In fact, I looked this up. Just work visas, there are almost 24 different types of work visas, and there are more than 100 type of overall visas. So this is profoundly confusing. Immigration is really complex. It has been oversimplified as a political issue. But when you get down to trying to make some policy here, these details are going to matter. And Trump is going to have to start making some distinctions if he's going to have any kind of meaningful change in American immigration policy.
Well, and who decides about that stuff, Rick? Because as always, it gets a little complicated. Does the number of H-1Bs, who is that determined by? Is that determined by a regulatory body? Is there something congressional in there? Who decides?
Right. As with most things, the correct and proper way and the best way to sort out problems is for Congress to spell it out mostly. So Congress has spelled out most of it. Congress created the H-1B visa program, and it determines how many people are let into the country in that program. I think the number is 85,000 per year. That's an extraordinarily small number. And Congress can change that. But then, of course, the president enforces these programs and interprets rules through regulations. And one of the big problems we have with immigration right now is that there are a lot of things that are just falling between the cracks that Congress has not addressed. What to do about the surge of migrants at the southwest border is a classic example. Biden let a lot of people in, and then that turned out to be politically popular. So in 2024, around the middle of this year, he just changed executive policy. That wasn't Congress, and that led to a severe decline in the number of migrants allowed in. But there's still huge problems. There aren't enough border agents. There aren't enough judges to process claims. And the real fixes here require Congress to act. Now, there have been members of Congress who've been trying to do this for, I think you can fairly say, decades, pass some kind of comprehensive immigration reform. It keeps getting hung up because of the demagoguery around this issue at the political level, which helped Donald Trump get elected in 2024. Let's not deny that. So very complicated, not nearly as simple as politicians want you to think it is.
Well, and to your point, there was a bill that was set to potentially pass earlier this year that he torpedoed effectively.
Yeah.
Exactly.
Right.
Rick, thanks as always. Appreciate it.
Hi, guys.
It's been another big year for holiday shopping, with some expecting online spend to surpass $240 billion. With more on what's driving holiday sales, we bring in Vivek Pandya. He's lead analyst at Adobe Digital Insights. Thank you so much for being here. So as we look at this spend, you guys have that estimate of $240 billion for online spending, which is an increase of about 8 to 9% year over year. What do you see as driving those spending increases, both in terms of verticals, where it's coming from, and what people are buying?
It's a great call out in terms of where the drivers are, because we're seeing a lot of price sensitivity on the part of the consumer, and we've really seen a lot of retailers provide really strong discounts online in the range of 10 to 30% through most of the season. So that's helped drive up momentum on many major categories, discretionary categories like electronics, cosmetics, toys. And that's been a welcome development for the season in order to get us to that 8 to 9% growth level.
People are shopping obviously on mobile a lot more too, but what's the rate of change and increase in adoption we see?
It's been quite staggering when we think about where mobile share was about 10 years ago. It was in the range of just over 30%. And now we're over 53% in terms of mobile spending. So it's not news that a lot of people are using smartphones for a lot of different use cases, spending a lot of time on apps. So that has implications for the online retail spending environment and how retailers can engage and compete on mobile devices through apps and make sure consumers are spending with them versus someone else.
And in terms of how people are making these decisions, I'm curious how much social media is playing a factor here, and influencers in terms of the click-through. Do you guys measure the click-through from, say, a TikTok shopping or a link that's on Instagram or Pinterest? Are there ways of measuring all of that?
Absolutely. So we look at specifically social affiliate partners. So we think about general social traffic coming in, and we also think about the influencers out there that are providing additional discounts and promo deals. And we're seeing growth up above 7% in terms of the online revenue share that channel is driving. So you're seeing a lot of consumers on these social media apps discover deals, discover items, and then certain influencers are able to kind of bring them through the channel in through the buying process. So that helps really drive up the momentum for social, and it helps inform strategy for many of these retailers and how much they think about their overall social media channel strategy and the engagement they do with influencers.
And how much of marketing dollars have we seen migrate to influencers from more traditional sort of ad campaigns?
Well, we've seen over the course of 3 to 4 years, just the momentum really tick up, especially when we think about the new entrants, TikTok, and the impact that's making. So I would say when we think about marketing dollars, there was a time when it was a kind of ancillary additional part of larger, broader programmatic campaigns, marketing campaigns. And now it's a central focus in terms of investment, both directly as a channel, as a part of their broader programmatic mix, and then also how it impacts their other marketing channels. So if they're engaging someone through search, how much are they also having social essentially jump on top of that? And essentially social is also now an influencer affiliate partner. So there's additional investment coming through that front as well.
We saw a lot of discounting sort of come back this holiday season. How sustainable do you think that discounting is going to be?
I think that discounting has really been a factor of the broader economic environment and the fact that you have online merchants, both domestic and offshore, really trying to gauge the US consumer. So pricing is very key in terms of how they can really make sure that the consumer is spending with them versus someone else. But they also want to make sure that they can get repeat purchasing, maybe have consumers purchase with them in the future, maybe not at the discount levels they got during this specific holiday season. So I think you're still going to have these eventized moments of buying, and that's going to be partly driven by discounts, but then you're going to have a broader strategy on the part of retailers to get that repeat purchasing and lifetime value to really be preserved and scale.
Vivek, thank you so much. Appreciate it.
Thank you.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
Focus on the trends, focus on those earnings reports. We're seeing earnings growth. Block out the noise.
Don't let emotions drive your investment decisions. Really important. Things like FOMO, you want to try to avoid that.
We're still bullish on stocks and would suggest to stay invested.
Pay attention to both their equity portfolios and their fixed income portfolios. Constantly reevaluate, are trades working, what's good out there, what should they be involved in.
Don't make any outsized bets based on potential policy or based on anything specifically coming out from Washington. Having a disciplined process over time across asset classes, within asset classes, is really important.
One thing we think is incredibly important in 2025 is that investors do not become too complacent. There has been a lot of optimism, a lot of good news heading into this year, but we don't want to turn a blind eye to potential risks that are out there.
It has been a year of records for the markets. The S&P 500 breaking 6,000, the Nasdaq topping 20,000, and the Dow closing above 40,000 for the first time. These achievements happening thanks to rallies fueled by Trump's election win, the start of the Fed's rate-cutting cycle, and of course the advancements in AI. Now, for many years, Yahoo Finance has crowned one company as Company of the Year, but this year we decided to go bigger with a suite of awards, including Comeback, Surprise, and Product of the Year. But while many companies had a chance to shine this year, there was one that shined the brightest in its field, from generating profits that outpaced the S&P 500 to its stock price outpacing key competitors. This company has become a force to be reckoned with in retail, making Walmart the pick for Yahoo Finance's Company of the Year award. I got the chance to sit down with Walmart CEO Doug McMillon to chat about their big year and the road ahead. I have told the Yahoo Finance team something has clicked at Walmart past 18 months. Something unlocked, something got unleashed. Like, what happened? Because your sales have accelerated, your profits have accelerated, and I don't see that happening at many of your competitors.
I go back to before the pandemic when I think about that and the work that we did to make some investments. We invested in wages for our associates. We invested in our people, things like education. We invested in lower prices. We invested in e-commerce. We invested in technology, all within a pretty tight period of time. That obviously creates some pressure on the bottom line, and that creates some overhang for how people think about Walmart. But if you get to the pandemic and you look at how behaviors changed, and curbside pickup, for example, grew at a much faster rate, delivery grew at a faster rate, that was work that we had already done before the pandemic that bore fruit during that period of time. And I think it caused a lot of people, customers, our associates, to recognize that we were on the right track. And we just kind of haven't looked back since then.
Every earnings report I've read from Walmart this year, maybe even a little bit last year, you're calling out upper income households, market share gains from upper income households. Why do you think you're gaining their dollars? And where do you think they're coming from?
I think, number one, we made things more convenient for everybody. Everybody wants to save money and everybody wants to save time. But it's a bit of a continuum depending on your income level. And in the recent years, we've changed enough things that make it more convenient to shop at Walmart that we've been able to retain people that make more money.
Why are prices still high for stuff?
Over the period of the pandemic, when supply chains got stretched, a number of things happened. Input costs went up, and so new levels have been reached that in some categories won't go back down. Now, general merchandise, things that are not food, has come back down much faster. In fact, we're right now in the US, we're deflated by about 4%. Fresh food is moving around quickly. We're just talking about eggs. Unfortunately, eggs are high right now. Some of the other categories have come down. Those cycle times are quicker. Dry grocery, consumables, kind of processed food and things like paper goods and cleaning supplies have been more stubborn. And they're much higher than they were 3 or 4 years ago. And we're obviously trying to work with our suppliers to get those prices down.
On the international business, also very, very strong year, really by country. Walmex, the Sam's businesses in China.
Yeah.
What do you attribute that to?
You've followed the company for a long time.
Back to Asda.
You've seen us, yes. You've seen us make investments in new areas like Flipkart and PhonePe in India. You've seen us exit some other markets. So one, we're in good businesses. Number two, we have leaders in the markets that are really capable. And then some of the other things we've done, the IP that's flowing across markets now with this strategy that we have, the tech that's flowing, supply chain expertise, the work that people are doing together to make the total greater than the sum of the parts is showing up in our international results.
Do you get concerned that, some of this momentum pulls back if we have a trade war?
We want prices to be low for our customers, and we want flow to go smoothly. So when we interact with governments, all governments, we try to advocate for that consistency. In the case of the U.S., we've had tariffs in place in various forms forever, I suppose, and a batch of tariffs that happened in 2017 that we're used to operating with. So, we're positioned to manage it, but what I worry about is customers experiencing higher prices, and we're going to do everything we can to try and keep them low.
Would it be easier to make more things in the U.S.? Is that possible?
It's growing. We work really hard on that, state by state, supplier by supplier, and we're making progress. Our U.S. percentage has been going up. We've established some big goals related to that.
Is this the year that a lot of tech initiatives that you put in place, maybe when I first talked to you in 2017, that they start to unlock? Like, what are the biggest tech initiatives that have changed Walmart?
In my experience, not some sort of breakthrough year. It's just a continuum. It's just been progress, dealing with tech debt, modernizing our architecture, creating more speed on front-end applications. If you look at kind of big picture what's happened in Walmart in recent years from a customer point of view, is you still have low prices, and now you've got access to hundreds of millions of items on Walmart.com. It's not just the store assortment. Walmart's different than it was before, and you get convenience. So, recent survey results have shown that customers are giving us about as much credit for convenience as they have price, and that was not the case before.
How do you think Gen AI is going to impact your business? Like, if if we're having this conversation 5 years from now, what changes will I notice in the store? Or maybe things I won't notice and they'll just magically show up on your earnings day?
I'm really excited about what's happened already, and it's an energizing experience as leaders to have to learn and apply so quickly. The cycle times as it relates to generative AI are much faster than a lot of the technology, maybe all the technology that I've dealt with in my career. It's going to help us be more anticipatory for customers and members. Search is going to change. The world will look more like personal shopping assistants than it will an old-fashioned search bar with a laundry list of results that you and I then have to work through as a customer. Just saving us time, making it more convenient, helping us solve problems. You know, in the past, if I wanted to throw a party for the college football playoffs, I was typing in soft drinks, chips, dip, whatever. Now I say, I'm throwing a party for the college football games. What do I need to know?
What does that next 10 years look like for Walmart?
Continued growth in the areas that we've already started. We probably launch some other new businesses along the way, and we keep changing everything we can to take all the stuff that people love about shopping and dial it up and invent new things related to discovery or other aspects of shopping that we love doing, and take all the things we don't like and try to get rid of them or diminish them. And technology will do that. Innovation that we as leaders and associates contribute to it will help do that. I think it's as simple as that. We're going to keep trying to make things better for customers.
Coming up, we'll reveal which legendary American company brushed off many challenges that have come its way, leaving Wall Street dumbfounded and securing its place as our surprise of the year. While there's been a lot to cheer for in 2024, the year did not come and go without its challenges. One company especially has been able to unexpectedly rise above several hurdles and race toward a strong finish. Yahoo Finance's Surprise of the Year award goes to General Motors. Here's what GM's longtime chair and CEO Mary Barra told me on the winding road for the automaker. Mary, great to get some time with you again. Congratulations on this award. We appreciate you joining Yahoo Finance. I know it's been a busy time. My first question to you here is, as an executive in the trenches all year, does your performance this year feel like a surprise to you?
Well, I think I'm so proud of the team at General Motors. They've all worked so hard to be able to deliver the strong performance as well as great vehicles. It's all fueled by vehicles we've been working on for a couple of years. We have the strongest internal combustion engine portfolio we've had in a long time. And this, what for General Motors, was the year of EVs. The portfolio of EVs that we have that cover the different segments from luxury to value, it really has given consumers choice between ICE and EV. And I think that's what's fueling our profitability. And people are starting to say, look and say they understand that this is a company that is differentiating itself in the industry.
What surprised you about the business as the year has gone on?
Well, I mean, there's been a lot of change. We're an industry in transformation, and GM itself is in the midst of making sure we're ready and proactive for the changes that are coming. But I think what was a pleasant surprise to me, I don't know if I'd call it a surprise, but I really felt validation for the team on how well received each of our EVs were.
You know, as you look back over the past few months, is there something that you would have liked to move faster with and that you're really focused on for next year?
Well, I think this year was really, again, getting the EVs out there to get the scale, because scale is going to be so important to drive to profitability. So next year, we'll continue to build on that, hitting more milestones of how we improve the profitability of our EVs. I think also we made some difficult decisions this year to set the business up for success, because we're trying to really be proactive and look at where is the business going. So the restructuring that we did in China and the pivot that we did to cruise, make no mistake, we are still 100% committed to autonomy, but we recognize there's quite a bit of capital that needs to be deployed into the rideshare business, and we want to deploy and work toward improving Super Cruise, getting to L3, L3 plus on our journey to L4.
You have Tesla wanting to drop robo-taxis, you now integrating your technology, Super Cruise technology into your vehicles. Are you not a believer in robo-taxi? It's not just a Tesla thing. We've heard also Uber, may want to have interest in this.
Well, I think robo-taxis are going to be important to get to really, I'll call it rideshare 2.0. We just looked at it, and operating a fleet of vehicles and all of the associated services and operations that are needed to do that is not our core business. We sell beautifully designed vehicles to consumers and to fleets, and they love technology. I mean, the feedback we get on Super Cruise is when people experience it, they say, 80% of them say, I wouldn't want to buy a car without it. And so as we looked at those insights and we looked at how we could accelerate our work in driver assistance technology, getting to L4 autonomy, we thought it was a faster path, a more focused path. And, our plan is to bring the two teams together, and between the expertise that we've brought into General Motors and the tremendous expertise that Cruise has, we think we can move faster and differentiate ourselves in this space as well.
You put a real flag in the ground many years ago, Mary, said we're going to be making all electric vehicles by 2035. Is that still your North Star and your hope?
Well, we still have a plan that allows us to get there, and so we're still executing to that plan. But the most important thing, and I've been saying this for a couple of years now, is we're going to be guided by the consumer. We want to give the consumer choice. What do they want to drive? We don't want to get into a situation where regulations are driving us to force something into the market that's not what they want. But I think once people start to drive an EV, they realize it's instant torque, beautifully designed. At least General Motors vehicles really give them a lot of technology in the right segments. And then not having to go to the gas station and the benefits of EVs, I think, is something that people are going to move to because it's a better product. What we need to do to accomplish that, though, is to have a robust charging network. And that's what GM Energy is working on with a number of partners.
Mary, I was just talking to the CEO of an apparel maker, and she was making the point, if we get tariffs, I could take what I make and move it to another country. But you can't do that in the auto business. I mean, you can't erect a new factory overnight or within 6 months. I mean, these are big buildings with machines, and you do make things in Mexico and Canada. I mean, how fast can you react if we get hit with tariffs?
Well, it depends on the product line of where we have production, because in some cases we have production in multiple plants. But I think what we want to make sure is people understand what the implications are and what it means to the U.S. economy from a jobs perspective, from a pricing perspective for consumers. So we're going to continue to communicate with all of the governments, and hopefully we'll get to a good decision. But either way, we're proactively looking and considering all the options that we have, so we'll adjust as appropriate.
Now, we can't look back on 2024 without talking about market darling Nvidia. The chipmaker continued its dominance from last year and is looking to stay ahead of the competition with its next generation AI chips, making Blackwell Yahoo Finance's choice for product of the year. Julie Hyman explains what makes Blackwell a cut above the rest.
Julie, I know you've done some amazing reporting on why this chip is so beloved.
Yeah, I mean, I will mention one of the ironies of this being picked as the product of the year. The thing didn't ship till the fourth quarter, right? But there has been such anticipation and such demand from the hyperscalers to get it to power their data centers and their large language models that's why we named it the product of the year. So if you look at some of the specs on this chip, and listen, I am not necessarily a semiconductor expert, but the numbers sort of tell the story here. So it has 208 billion transistors. That is more than 2.5 times that of Hopper, which was the predecessor chips. And then there's something that NVIDIA talks a lot about, and other chip makers too, which is the so-called total cost of ownership. Blackwell is expensive. It is the most advanced and therefore the most expensive GPU on the market. However, NVIDIA argues that because it is highly energy efficient, the total cost of ownership over the lifetime of the chip makes more sense. And then it's not just Blackwell that NVIDIA is selling, it's really a whole computing system. So it combines with the Grace CPU for a full rack of computing power. That's what's going into these data centers. Now, CEO Jensen Huang, he rolled this out. He first introduced this in March. And here's what he said about Blackwell at the time.
There's no memory locality issues, no cache issues. It's just one giant chip. And so when we were told that Blackwell's ambitions were beyond the limits of physics, the engineer said, so what? And so this is what happened. And so this is the Blackwell chip.
So it's showing there the physical chip. It is the largest GPU ever made as well, we should mention. And it's made by using two die, basically two chips that are connected by a high bandwidth interface. That was one of the leaps, the innovation leaps that NVIDIA made in developing the chip. You can see what it's already done. Well, if you look at the revenue growth that we have seen for NVIDIA already, as I said, Blackwell didn't actually ship till the fourth quarter of the year. So a lot of this is demand for other data center chips like Hopper, what we've seen thus far. But the real surprise began for NVIDIA, not this year, but last May when we had that big upside surprise in revenue. And then the company's revenue has just continued to grow here, although at a somewhat slower rate, the bigger it has gotten, Maddie.
What are your sources telling you just about the path forward for NVIDIA and whether Blackwell will be enough to keep NVIDIA as the leader?
So let's be clear here. NVIDIA is still absolutely dominant in this space. When I talk to analysts, I talk to Ben Beheron, I talk to John Vin over at KeyBank, and they talk about 80% plus of the control that NVIDIA currently has on this data center generative AI LLM market, right? So they are hugely dominant. And when you look through the next year, Vin said, as long as they can solve some of their manufacturing bottlenecks that they have had and get the flywheel going, then they'll be fine. Yes, the revenue growth is expected to slow, but again, that's because they're coming from higher and higher numbers, and demand doesn't seem to be of a concern. The competitive threat is going to come from custom chips, most likely. AMD, yes, but Broadcom, as we've been increasingly talking about, got a lot of attention in its most recent report, talking about the increase in demand for custom chips. But again, when I talked to analysts, they said the custom chips aren't there yet. They are not yet competitive. They're going to chip away, they're going to increase, and at some point maybe they will be there. But if you look over the next year, doesn't seem like that is yet happening. You have to maybe look further out to see the changes that are perhaps going to come.
AI has certainly been a top theme of 2024, but so has one asset class, crypto. And in that space comes our pick for comeback of the year. Find out who it is on the other side. Crypto making a grand return to the spotlight in 2024, with Bitcoin topping $100,000 for the very first time. But which name stood out to win Yahoo Finance's comeback of the year? Well, that honor goes to Robinhood, as the company became consistently profitable while delivering a host of new products for investors. Here's what co-founder and CEO Vlad Tenev had to share with me on the company's comeback journey.
I think for people to understand what has happened to your business, we have to go back to some of those like lower points in the business for you, for as a leader in a business. I mean, what were those like, and how'd you get out of them?
I think 2022 was challenging, and 2021 when we went public actually had some stress as well. I remember when we entered the public markets. I mean, it was sort of at the height of the secular bull market, and we felt good, but the business now is much stronger across pretty much all dimensions. We have 9 business lines that are generating over 100 million in annual revenue. Business very diversified, growing across our main priorities of active trading, growing wallet share for the next generation.
Big year for the company stock price, big year for your company financially. This could be a really different company 10 years from now. Like, what is your vision for Robinhood?
I think the vision really is for anyone, anywhere in the world, whether you're an individual retail investor or an institution, Robinhood should be the best place for you to custody all of your financial assets and process all of your financial transactions. And so it's expanding across the 2 dimensions I mentioned earlier, going global, where we've got lots of winds blowing. The rest of the world is getting wealthier. It's going to the technological frontier. Mobile penetration continues to go up. Internet is becoming ubiquitous. There's multiple trends that are moving towards more self-directed, more focus on US products and US markets, and AI and cryptocurrency sort of booming at the same time. And Robinhood can really be at the center of these things, and I think those are going to be the growth drivers in the financial industry over the next 10 years.
How happy are you that Gary Gensler's out the door, and we have potentially this guy, Paul Atkins, who sure seems bullish or more bullish on crypto than Gensler?
Yeah, I mean, I think that Paul Atkins, we're very excited about him taking on the mantle and getting the agency pointed in the right direction again. I think the American public wants to know that regulation is here and that they have standard protections. There's good reasons for regulation in the first place. You want to avoid all the downsides and all the hard lessons we learned in the traditional financial markets that led to it in the first place. And we're very optimistic about that. And we're also looking forward to the end of the regulation by enforcement approach that has been bad for the industry, frankly, and bad for the public in the U.S.
If investors are trying to make sense of this move in Bitcoin and other cryptos, what do you think happens in the first year? What's the biggest unlock that you would like to see in the crypto industry from this administration?
Well, I think there will be a push for comprehensive crypto legislation. There's a stablecoin bill that got battered around a little bit, never made it to the Senate. That will probably be reproposed, maybe in a slightly different form. So there's talk of a Bitcoin strategic reserve, and I think if that happens,
what does that do to a business like Robinhood?
Well, we've been early to crypto, and we're one of the few public companies that actually has a large crypto business associated with it. So as the industry grows, I think Robinhood is well positioned to benefit from that.
When you look at the company, like how you made some comments on sports betting. I was trying to figure a way to ask it, but do you want to be that broad? I mean, are you going to go toe-to-toe with Yahoo Sports? I mean, what's your ambitions? Clarify that stuff for us.
I think that was taken a bit out of context. There was a question about the election product we rolled out. So we're going to broaden that. We're going to have a more expansive regulated events offering, and these are CFTC derivatives, so federally regulated. There's all kinds of contracts and events that are permissible that we'd want to allow people to trade.
Do you have ambitions that, or view that you want Robinhood to be this generation's JP Morgan?
Well, one of the things we care about, this is the second arc, our 5-year arc, what we call it, to be the leader in wallet share for the next generation. And right now, Robinhood has more millennial and Gen Z customers than the leading brokerages.
Millennials?
Millennial penetration, and Gen Z is even higher, actually. So we see an opportunity to help them with all of their financial needs, with an emphasis on multi-generational needs. So we want to serve their parents, their kids, and I think that's something that the existing industry players don't get right. Nobody has a great kind of like family, multi-generational experience. And I think there's low-hanging fruit there. If we serve the whole family and really have a great integrated experience, which our recent acquisition of Trade PMR should help facilitate, I think Robinhood can be the place where, you actually like stick with.
That's a wrap on Yahoo Finance's 2024 awards. Thank you for watching.